Good evening, everyone. Welcome to IQI Canada Evening Talks. My name is Yusuf Iqbal, country head of July IQI Canada, and we are back with our favorite session for the month, which is the economic update by none other than our chief economist, Shan Saeed. Good morning, Shan. How are you doing?
Good morning, Yusuf. Thanks for having me again.
Thank you, Shan, for giving us your time. It's been almost like, a year and a half since we've been talking about it, and your valuable insights means a lot, for the all smart and sophisticated investors, especially around this time of the year, I would say, or around this time, we know what's going on in the market. But for our viewers, if you really want to follow Shan, please follow Shan on LinkedIn, follow him on Facebook. Shan is everywhere. Every day he's being quoted by Star News and a lot of other newspapers as well. And Shan, you know what? So many things are happening around, and that is the reason one of my favorite sessions is with Shan because it really gives a lot of insights for this. So thank you very much for that, Shan.
It is my pleasure, Yusuf.
So Shan, I want to start straight away to certain questions, and before that, I just want to get started up and seeing like what's going on. Sean, inflation everywhere. I mean, recession is happening in a few countries, and a few recession is knocking on the doors. Now, according to the Economist magazine, America raises the rates. The rest of the world, bears the pain. The Federal Reserve's latest lift offers little help to the global economy. On September 21st, the Fed announced a 0.75 percentage point interest rate increase. It's third in a row. The Fed's benchmark now stands at 3 to 3.25%, up by 3 percentage points since the start of the year. While the rise was forecast, the central bank offered a surprise that new projections revealed that rates would probably continue to rise for more than 4.5% to 4.75% at the end of 2023, higher than expected. The value of the dollar has risen about 2.5% over the past month alone and by 17% year to date. Where do we begin from here, Sean? Like the markets are in a turmoil. Investors have lost 53 trillion in the global equity markets. Can we expect some stability in the market in the near future? I mean, like what's going to happen after 4 to 5 months?
Thank you, Yusuf. I think not only you, but many investors are actually asking this question. And day before yesterday, I was attending a networking event, and somebody asked me the same question. Shan, do you foresee any stability in the market in the next 4 to 5 months? And I said, I don't see the market settling down very soon. Fed has given a real surprise on 21st September when they raised the rates around 75 basis point. So the market was expecting the Fed would continue to raise rates. In our last newsletter, we shared from Goldman Sachs that they were saying 50 basis point, but the Fed went higher with 25 basis points more. It clearly reflects that Fed is quite hawkish in terms of the uh, inflationary outlook, and they want to contain inflation, and the market will stay uncertain. Investors, as you rightly said, they are nervous. They have lost a lot of money in equity and bond markets, and that creates a real uh, confusion in the market. Where do I put my funds? So we are back in 1933s, we are back in 1970, we are back in 1929. I still remember I was reading economic history. The period from 1929 to 1932 was a real turmoil for the market, especially in US. But from 1933 to 1936, the markets were booming. And then in 1937, Fed messed up everything because the dollar was strong. They kept on raising rates and the markets went down. Similar situation is happening right now. We are in 1937. A lot of people have asked me where we are. I said there's so many things at the moment. So we have stagflation, as you rightly pointed out, in 60% of the global economy. There are 194 countries, So already 116, 117 countries are in stagflation. What is stagflation? When your inflation is up and you have weak growth. And that's a real concern for many policymakers. And then we go back to 1933 and 1937 meltdown. The way that you have mentioned, the markets are behaving erratically. Investors are nervous. Human psychology, consumer behavior, investors' behavior, they all are in play. And nobody knows where the direction of the market will be. All the banks are revising their forecast downwards for many equity markets, and rightly so, because markets are still overvalued, because markets have enjoyed QE for quite some time now. And I still remember in 2014, one of my professors at University of Chicago, who taught me macroeconomics, Professor John Huizinga, he made a very important statement that QE has borrowed future growth rate. When you print money, you try to induce consumers to buy more, to spend more. So you're trying to achieve growth as of today. You're not trying to focus on the growth tomorrow. So I think, in my opinion, next 5 to 6 months will be very crucial for the global economy. Number one, I don't see the markets settling down very soon. The markets are whistling past the graveyard. There is an asset flip. Bonds have become equities, and equities have become bonds, and everyone has become a daytime trader. So, how do you navigate through these tumultuous and tempestuous time? It could be anybody's art, but in my opinion, I can say very openly that I am having sleepless nights the way the markets are behaving and the way the currency market is behaving. So you see, you rightly pointed out,
Yeah.
dollar has gone up in a month's time 2.5%, and year to date it has gone up 16-17%. And stronger dollar is bad for the global trade, because 85% of the global trade happens in US dollar. So if dollar stays stronger, I mean, obviously you're exporting inflation to other economies. So when dollar becomes stronger, other currencies become they start depreciating. So when your currency depreciates, it brings in inflation to the country, and that is not healthy. So a lot of central banks, as of today, when I speak to you, 89 central banks have raised their rates this year. 89. This
Wow.
is highest in the history of the global economy and financial markets. 89 central banks have raised rates because inflation is not in control, is getting out of control. And inflation will continue to stay stronger for many economies. But I still remember in Economist magazine, 3 months ago, on 25th June, they published an article, The Island of Price Stability. And they mentioned about that inflation will stay higher in advanced economies, but inflation will stay lower in Asia. Why Asia? Why advanced economies? You see, most of the manufacturing is happening in Asia. Asia produces a lot of natural resources and
Yeah.
they export. On the other hand, many advanced economies, they don't produce much. They don't have the manufacturing facility. They have, but very little. And they import most of the stuff like Europe, UK, North America, they import from Asia. So once you import from Asia, it gets, little expensive for you. So I don't see the inflation coming down very soon. It will take 2 years for inflation to come down. I made a statement 3 months ago that I foresee global economy recovering in 2025, but I think it will take a much longer. It will not take 2025. It will be much longer. So I don't foresee the market settling down very soon.
Wow. Sleepless nights, definitely what you're telling me is definitely sleepless nights. Market not settling up in next couple of years. Definitely, as you said, 89 countries of central banks of increasing up their interest. Definitely, the market when we're talking about inflation, recession, trying to control inflation, a lot more things to consider on it. It's actually good to hear from somebody like you know that how the market is going to behave so that people can actually plan themselves accordingly as well on that. So, Shan, that brings me to my next questions. As you know, let me give you a statement. Like markets are behaving erratically. You know, investors are nervous in both equity and the bond markets. You know, any similarity from 1993 when we had a Great Depression? According to Janet Yellen interview with Bloomberg, she said that markets functioning well, conditions not disorderly. Unquote. Look at the inflation numbers globally. Latest inflation figures reported in Economist magazine came out China for 2.5%, USA 8.3%, Euro 9%, Canada 7%, Australia 6.1%, UK 9.9%, Singapore 7%, Thailand 7.9%, Indonesia 4.7%, Malaysia 4.7%, Philippines 6.3%, South Korea 5.7%. Like, what do you say about that?
Yes, there are a lot of similarities. What happened in 1929? I have read economic history. On 18th and 19th October 1929, the Dow went down by 80%. And just in one day, on 18th October 1929, the market went down by 11%. And then on the second day, on 19th October, the market went down by 12%. So in 2 days, market went down by 23%. And overall, Dow went down by 80% in 1929. So we are seeing similar patterns in the equity market and the way bond market is behaving. Look at the gilt market in UK. It really broke, and then the Bank of England had to intervene to support the bond market. So I think there are a lot of similarities. 1929 to 1932, the markets remained very bad. They were very shaky. Investors were panicking. And from 1933 to 1936, the markets were booming. And then again in 1937, the markets were pretty bad because the Fed started panicking and they started raising the rates. So I think similar things are happening right now. As far as inflation numbers that you have given, this is the latest issue from Economist magazine that you are sharing. I think the inflation numbers will stay stubborn and they will remain serious. I still remember last year, Janet Yellen was saying that inflation is transitory, inflation is temporary, it will peak in August, September 2021, and then it will come down. And I went on Astro Avani from May 2021 and I told them that this inflation is serious and it will continue. The anchor kept on asking me 2, 3 months, Shan, Janet Yellen is saying. I said, my friend, if you read Economist magazine, 2015 issue, the title of that article was Funny Numbers, page 66, October
Wow.
25th, 31,
Wow.
31st October 2015 issue. The title of that article was Funny Numbers. First
Wow.
paragraph, third line, the markets are not believing what Janet Yellen was saying. This is 2015. So markets and market participants, they don't really follow Janet Yellen because the lady, unfortunately, she does not have any idea what's happening in the global economy, what's happening in the markets. Again, Janet Yellen and the Fed chair Jerome Powell, they misread the market and they said there will not be any recession. US is already in recession. They said inflation will come down. Inflation is going higher. Inflation just came down in July and August because the energy prices came down. But if you see right now, energy prices are up again and they're trading at $89 per barrel, up more than 10% year to date. But the way I see things, inflation will remain strong because once energy consumption it goes up in Europe, the demand will go up. Demand will go up. Obviously, everything is related to energy. Your life and my life, it all depends on oil and gas.
Yep.
How can you move around without oil and gas? How you
You
can
can't.
switch on your AC
You
without oil
can't.
and gas? Manufacturing, everything is related with oil and gas. So if when oil and gas prices they go up, obviously everything gets impacted. Whether it's food, whether it's school fees, college fees, your manufacturing, your energy bills, everything goes up. So I think inflation numbers will stay higher and it will be a real challenge for central banks. But if you recall our April issue, we have already mentioned that the global economy started with stagflation,
Yeah.
then we will have recession, and then next year onwards we will have QE 5 or 6. I have lost count. So central bank will resort to QE because they will say the markets are not getting confidence. We have to give confidence back to the economy. The equity and bond markets all will start booming, but not so soon. I think the market will remain very, very shaky.
Wow. So looks like the inflation numbers are going to be stubborn for some time, and we don't see them really coming down. As we were expecting it to go down on that. That brings me to my third question, Sean. Financial Times reported that global backlash in brewing against Fed due to its unpredictable moves and wrong analysis about the market. Can we expect that global central bank urging for immediate intervention? Markets are in turmoil and investors are shaky. Your thoughts, please, on that.
Last Monday, I was on Astro Avani and we had this program. Does the global economy need Plaza Accord? What happened in 1985 when the US dollar was very strong? US dollar was trading 240 against Japanese yen, and then the Japanese yen had to be revalued to 140 because it was so weak against USD. I think Financial Times, Wall Street Journal, all these, they mentioned about the global economy needs intervention from central banks. The central banks, they need to sit together and they need to make a coordinated effort so that stronger dollar is not helping the cause, and they need to reevaluate the currencies by at least 5 to 10%, because if they revalue the currency, then the fair market value of all the currencies will come back to their original level. But at the moment it looks quite an uphill task. Everybody is at the mercy of Fed. So when everybody is at the mercy of Fed, you don't know what is happening. Everybody was waiting for what the Fed will do on 21st September, what the Fed will do on 20th September. So when the rates were increased to 75 basis point, the markets went down, especially the equity markets, and the bond market started shaking. And even the housing market is feeling the pressure, not much, but sophisticated and smart investors, they already knew what was coming. So in these turbulent times, one thing that you can share with your valued investors, information has become key.
Yeah.
If you have got the solid market intelligence reconnaissance, which is backed by facts and figures, and your investors can benefit and leverage from that, I think that will give you a huge advantage with your sophisticated and smart investors. They will obviously come back to you. I know you are very much in demand whenever those investors in Toronto or Mississauga or Cambridge or Vancouver or Calgary, they want some advice. They always seek your guidance and wisdom. So I think sharing with them the important information from Economist magazine, Wall Street Journal, Financial Times, it is really going to help those investors in making smart decisions. Investors are looking for solid substance. They are not looking for form. You can do a lot of things, but at the end of the day, it's all about substance. And money is a serious business. You have
That's
seen,
true.
I have gone to public events. Some speakers I have seen, they laugh and they make a lot of jokes. But when it comes to your money, it's a serious business.
True.
So you cannot laugh around and you say, oh, the interest rates are going up, the markets are going down. No, you have to be very, very serious, because when people are placing funds with you, $1 million or $1.5 million, they want solid information.
True.
And that's how you bring repeat sale. That's how you increase your market share. And that's how, because of those investors' confidence in you, IQA Canada is doing a great work. So I
Yeah.
think market intelligence reports, solid data that you can share from these journals and newspapers, I think you will have great engagement with your sophisticated and smart investors.
Well, thank you so much, Sean. You know what? This kind of market intelligence report and the information which we are giving to our clients Definitely, I want people to understand that how this movement is triggered because of our global network, and of course, people like Shan, Saeed, our chief economist, who are every day analyzing, looking at the markets, giving us the advice, and that's how we are able to go and advise to our clients that how the market should be behaving. If we got $1 million to invest, it's just not. We always call ourselves as trusted advisors, not a salesperson, and the reason because of that, there's a lot of information behind which is backing us up, when we are advising our clients at the same time. So thank you, Sean, for that. I must say that because a lot of all of viewers who listen to us, yes, we're advising, but right behind IQI Canada, there's a huge global team. And Shan Saeed, our chief economist, who keeps on giving that information to us that what should be the expected, market is going to be around at that. And that is where these smart and sophisticated investors, make the right or the calculative decision. And that's how we help our investors as well. Thank you for that, Sean. My next question is on Wall Street Journal, dated September 20th, with the article heading by Powell Channel's Walker. Is Fed following the Walker playbook of 1980 to 82? Will the Fed succeed after in applying the same case study? Can it work in 2022? That's your thoughts on that, please.
Yes, what the Wall Street Journal reported about Jerome Powell, he's using the same playbook what Paul Walker did in 1980s. So in 1973 and 1979 we had oil shock globally, and then from at that point onwards, US started raising interest rates from 1979 80 onwards, and from 1976 to 1981 US dollar lost 50% of its value. So imagine during that time, gold prices went up from $150 per ounce in 1976 to $850 per ounce on 20th January 1980. And then in 1981, the gold price touched $600 per ounce. So I think Jerome Powell, he wants to use, yes, this page, he wants to use the similar playbook what Paul Walker did, but the variables are very different. The variables are different. You have Ukraine Russia conflict, you have shortages coming into the economy, you have supply chain hiccups, you have geopolitical risk, you have shortages of workers, and above all, prices are rising of food and energy. Some similarities are there, but there are a lot of variables that are exogenous, that are beyond your control. How you going to control those external factors? That's a huge challenge. So the will the Jerome Powell succeed at this point of time? Premature to say, but the way he has put a hawkish stance, what do I actually mean by hawkish stance? He said in March the interest rates were zero, and now we are sitting in September, the interest rates are at 3 and 3.25%. So that shows that Fed is panicking, and Fed is behind the curve. They don't know how to control inflation. 4 years ago, if you have $200, you can buy your average grocery very easily in US. Now you need $800 to buy a grocery of a month.
That's true.
So that is 4 time increase. That is 4 time increase.
Agreed,
So
agreed, agreed.
that's a huge challenge at the moment. So I would say that the markets will continue to monitor what Jerome Powell is doing, but I'm not sure how the markets are going to react in the next 1 month or so.
Wow. I agree with you. Talking about the grocery rates and things like that. That's what we are seeing. That everything is becoming expensive. Something which people are able to do it for $200 go to $800, and unfortunately, the income levels are not going up. At the same time, the way that things are getting expensive on that, so which is definitely showing that a personal deficit in your own people's own income as well. And that means is that a lot of debt comes on them at the same time because they're using the plastic money rather than the actual money on there, which does put them into different issue as well on that. So Shan, let's come over to Canada. The main question the investors are asking these days, and I'm sure you get it every time as well. Will the interest rates come down in the coming quarters? If the 1970 era is back, how to position yourself against stagflation and higher interest rate regime. What should be my street smart strategy to navigate through these, tumultuous time of the modern era?
You have copied the street smart strategy terminology from me. You have again copied.
And we learn from you
Yusuf,
every day, right? We learn from you every day.
thank you so much. Yusuf, these questions are very, very valid. And to tell you honestly, investors are nervous. To tell you very honestly. So, what investors they need to do, what should be the street smart strategy? Street smart strategy is you learn from others, you learn from history. So, history teaches us in 1970s when we had stagflation, those sophisticated and smart investors they took position in tangible assets.
Yeah.
How can you go wrong? In every inflation, in every recession, tangible assets, real estate, gold, silver, they protect your wealth. They protect your children. They protect your future generation. So, when you talk to these clients, your valued clients in Canada or globally, those sophisticated and smart clients, they want something tangible. You can go and touch the walls of your house. This is not Bitcoin. Bitcoin is
True.
in the air. Your
True.
house is, on the ground. You can touch the walls of your house. You can see the kitchen, the drawing room, and everything. So I think you can go back to your investors and you can tell them that yes, interest rates will continue to go up, but your street smart strategy should be that you should take position in tangible assets. You have already shared at the start of the program that equity and bond markets are in total shenanigan. I
Yeah.
mean, investors have lost $59 trillion. Imagine the global GDP size is $100 trillion. The
Wow. Yeah.
global debt is $304 trillion. The global wealth is around $470 trillion. So, $100 trillion of global GDP and investors have lost 59 trillion. So, that is 59% of the global GDP. That is huge. It has never happened.
Huge. Yeah.
2020, similar things happened. Investors lost $47 trillion year to date, 2020. And now we are not even finished the third quarter. Investors have lost $59 trillion year to date in equity and bond markets. And that's huge. That's massive. So interest rates will continue to go up, yes, globally. Inflation will stay higher. So your street smart strategy should be to take position in tangible assets. Understand your risk profile, understand your risk reward ratio, and above all, you need to have an exit strategy. And real estate is a long term game. It's not 1 year, 2 year, 3 year. It's a cycle, 10, 15, 20 year cycle. So you have to look at the long term, how you can protect your wealth. And in these turbulent times, the number one strategy should be how to protect your capital, how to increase $100 to $101 or $102. They should not go below $100. Then you need
Agree.
to revisit your strategy, your investment strategy. You need to visit your asset portfolio. Where did you go wrong? So you
Sure.
need to position yourself in a way that you protect your wealth. If you can protect your wealth, you can do wonders. It means you are smart, that you have protected your capital. You have preserved your capital for your future generation. And why do you make investment? You make investment for your future generation so
True.
that they are financially and economically secure.
Yeah. That's
So I
true.
think my opinion would be that you should go back to your sophisticated and smart investors and you should tell them that the way things are shaping up, intangible assets can give you peace of mind. Other asset classes, I would say, they will give you sleepless nights.
Oh, absolutely, absolutely. Just to the dot, the good thing is that, like what you're saying is that people need to understand that, and what we have actually seen in the Canadian market over the years is that, the tangible assets or the real estate, I'll talk specifically, we have seen a growth on their real estate. A lot of people are asking this question right now that, oh, interest is going to go up. What's going to happen to the properties? Are they going to go down? Very interestingly, Shan, we do the market update for the Toronto Real Estate Board, and what we're seeing is that the prices have been stable on that. They're not going down. They're not drastically going up. What we have seen in the month of January, February, and March, which was not a regular market, and that's the time when we were telling to all our advisors, this is not a regular market. Stay on that market on that. And what we're advising our clients right now, Sean, at the same time is, look for those long-term closings, anything which is going to close after, as you were saying right now, 25, 26. Well, we're advising our clients, go for those projects which close in 27, 28 for that matter of reason. The reason is that, if the market is not getting okay in next 1 year or 2 years or 3 years time, you should go for those kind of investments on that. Or at the same time, if you are, cash rich and have that capacity of holding on to this asset, this is the time to hold on to those assets right now. And that's what we're seeing in the market right now. People are asking us like the prices are going to go down, and I'm asking this question to the people that if I own a property today, and if I don't have to sell, do I really need to put my property into the market? The only way I will sell is that if I'm trying to upgrade myself, I'll say, I have to go on that. And we are seeing a very sharp decline in terms of listings as well. There's not a lot more good properties going on in this market as well, Shan. People are doing some multiple biddings on some very good properties. I mean, we went through one of those multiple bidding properties with some of our clients, 22, 23 offers coming up on the property in this market as well. So what it actually says, what you're saying is that, smart, sophisticated investors are looking for those tangible assets. Yes, they are looking for deals at the same time, but they know in the long run, if this is where the money they're going to invest is going to hold on to it. Absolutely correct. The interest rate is always a question which, being asked to us that with this interest rates going up on that, what should be the expectations, how much is going to go up on it and things like that, and how it's going to affect the market. Because a lot of people are thinking that as soon as the interest goes up, the markets the price is going to keep coming down on it. But what we're seeing is that it's a stability right now in terms of the real estate assets. People are holding on to their prices, and people are actually willing to pay that kind of price as well, which is the correct market price on that. So thank you very much for that, Sean. Anything else you want to add before we say bye to our audience?
Yes, definitely. Yusuf, you have mentioned two, three very important points. One is stability.
Yeah,
The beauty of Canadian real estate market is it has got stability. It's a mature market. It's not for everyone. If you have got above $1 million, yes, you can enter the market. And even in these tumultuous time, if you are seeing bidding of 22, 23 for every listing, it means those sophisticated and smart investors, they value the real estate. And as we say, real estate has become the new global currency. On Tuesday, I was cited in Singapore's newspaper, Business Time, and I mentioned the same. Real estate has become the new global currency. So, what we shared in 2015, the book that we have published, now
yeah,
everybody is talking about real estate, not about individual investors. You look at BlackRock, you look at institutional investors, Blackstone, everybody is going into real estate. Norwegian sovereign wealth fund, they have got 30% of the stakes in real estate. Norwegian sovereign wealth fund is one of the
wow,
largest, $1
yeah,
trillion AUM.
wow,
They have put 30% of their $1 trillion of funds in real estate. So when these sophisticated investors, sovereign wealth funds, family offices, hedge funds, fund managers, they come and take position in real estate, it means it's a clear signal that investors are valuing this asset class. And real estate, people who understand history and economics, they have always taken position in real estate, gold, and silver. So I think you have rightly mentioned the Canadian real estate market. The biggest advantage that you have is the stability. It's a mature market. It's a well-regulated market, and it is a very structured market for those sophisticated and smart investors.
great. Thank you very much, Sean. I wish we could just keep on continuing this session. There's so much to talk about it, but I know you have also a time limitation on that. Thank you so much, Sean, for your valuable insights. Always, always, it's a pleasure having you on our evening talks, and I'm sure all our viewers who listen to us, they benefit a lot from your insights as well. So thank you very much for that. Take care, Mr. Shan. Till next month, we'll see you again. Thank you. Bye
Thank you for
bye.
having me, Yusuf.
Thank you, sir.